Hi, this is Randy Finney with the right side of the chart, and today is Thursday, April 25th, 2019. It's about a little after 1 o'clock Eastern time as I'm starting this video. So markets are still open. I want to do a video on the semiconductors. I think it's time to do an update. So what we'll do is we'll look at the sector itself. We'll look at the three main ETFs that track the semis, and then a handful of the top components to kind of round out both potential trading ops and also to confirm or some cases refute what I'm seeing in the charts. I'll go through, look at a sector, an index, and sometimes the charts of the individual components won't really confirm what I'm seeing. And trading can be tough enough. So what you want to do is, if you can really drill down in the charts, and you can't make a solid case if the individual components of a sector overall aren't supporting the case that you're looking at, whether it's bullish or bearish, stand aside. Just wait for it to set up and clearly confirm a bullish or bearish move. So let's start out here with SOXX. This is the Philex Semiconductor Sector Index. This has been around. This is the longest standing semiconductor ETF. This is the one I like to track for two reasons. This is the ETF SOXX, which we're going to get to in a minute, tracks this index. And the two main semiconductor short ETFs that a lot of people like to use if they're leveraging up the three-time bullish and bearish ones. That's SOXL for semis long, I guess, and XOSX for semis short. This is SOXX. This is a daily chart. Very simple. I don't have any other annotations on here. Here's a trend line. A lot like the stock market in the tech sector, the semis bottomed back on the 24th of December, and you have a pretty clean up trend line. Let's not make it any more complicated than that. Semis are very much comfortably above that level now. But let me tell you this. The semis can and often do turn on a dime. They are a trendy little sector. A lot like crude oil. They do have some periods where they kind of consolidate and grind around, but they are also prone to having these unidirectional sharp trends that turn on a dime. And that's why I'm doing this video. I don't want to do this video 3, 4, 5, 8 days after the semis are broken down. Why? Because you may be down here and you may be denied an objective entry. I like to get ahead of this. There's not any sell signals now, but there are some potential objective shorting ops that I'm going to go over in this video. You may want to start building position, but look at this. Look at this big red candle back there. Huge bearish engulfing, and it never looked back. So what the semis do with these moves, it's like the shippers I talked about quite a bit lately. It's full of momentum players, and when the momentum players are in, it's like a game of musical chairs. As long as the music's playing, hey, great, join the party. But when the music stops, or the lights come on. If you ever worked in a bar or stayed, closed one down, lights come on at night. They try to run you out. You don't want to be the last one there standing, and that's the case with the semis. So again, this one could end with a whimper or could end with a bang. And hence, I'm doing this video ahead of time to show you some levels on both the ETFs and the individual stocks. Let's just take a long-term look at the semiconductor sector. This is a monthly chart, and this goes back to the mid-90s. And you can see, well, let me just show you a couple things here. First of all, like I said, it is a very trendy sector, meaning clear bullish and bearish trends, not a lot of in between. So given I grossly underestimated, I had some personal long exposure on semis. I can't remember if we had a long trade idea at the bottom. I was long in the market. I didn't expect it to go this high. The stock market's only slightly above my uppermost bounce target, just marginal, a couple percentage points. This one's gone up a lot more than I thought. But again, I can't catch them all. I didn't see the semis rally of this magnitude, but that doesn't mean that I'm not going to be ready to catch the next downtrend now. And you can see again, and let me just put these in perspective for you to show you how much these drops can be, or the rallies. 55% drop on that correction or bear market from top to bottom. This one was 85%. This one here doesn't look like much, still 34%. So again, you get the picture. Even these small little quote-unquote corrections are 30% or more, and there's a 70% drop in stocks back in the last bear market. And the thing about any sector or any security is typically the bigger and more extended the run leading up to the top, the more powerful the correction. You have little rallies, you get little corrections. Little rallies, little corrections. This is the most powerful run. Now, it's not a very dangerously steep run, at least on this scale. This is a monthly chart, but that's a big bull market. And one would expect that at some point in time, there's going to be a big bear market to follow. Let's just right now focus on the daily charts and first off getting a sell signal to begin with. All right, so let's go back to, or let's go to the ETF itself. We were just looking at the sector. This is SOXX ETF. Again, it tracks the sector, so charts are going to be nearly identical. Here's the trend line I showed you. This is the primary trend line off the lows on the 24th, and that's the one that needs a break. But I also have an alternative trend line here that bears watching. There's some reactions on there. You can replicate that one. We have almost divergence here. We have divergence on the other semi ETFs. I'll get to those in a second. But what we have here is one of the most overbought readings. In fact, the last time in years that we were this overbought, or the two times, here I'll show you. I'll put a line up there for you. Let's look at this. So I'm going to put a line, and what I'm doing is I'm capturing the highs of this overbought reading right here, and you can see going back, this is a 2-year span on this chart. Only twice have we been that oversold. You can see what happened since then. This one, in a single day from high to low, that the ETF dropped 7%. It was a huge bearish engulfing candle. It didn't, what the semis tend to do during a rally is they don't like to make it easy on the longs or shorts. They trapped a lot of longs in on that, and they probably denied a lot of shorts an entry. And from top to bottom, the thing fell in just a few weeks, 11%. And again, that came after an extreme overbought reading. So the semis are dangerous right now. We don't have a sell signal, but this is what happens. On this extreme overbought reading, we had a little correction, pushed up just a couple weeks later with divergence. You can see right here, small divergence, and then boom, that one dropped in just a matter of about a week or so there, about almost a 10% drop, and almost straight down. That's a waterfall type sell-off. Now, another takeaway from this chart is, the divergences. So I'm going to go over the other semi ETFs here in a second, but you can see, like back here, I just showed you, SOX had a small divergent low, and it had a relatively small correction, relatively speaking to the moves it makes. It pushed up, extended the divergence, put in a second consecutive divergent low, simply an extension of the first, and a bigger correction. That was probably a, 12-15% drop. And then continued. So the point here is divergences work much more often than not. I say well over 90% of the time when they're confirmed. Confirmed with a bearish crossover that effectively puts in a lower low on the PPO. And so you had here a series of 1, 2, 3 consecutive divergences, but finally it was that third one that took it down and led to this drop, because that was the highs right here in SOX. We never matched that high. This was just a lower high, and then they fell off a cliff. So that was, what was that drop? Let me move that line right there, kind of come in here. Roughly, if I can get in right near it, yeah, it was a big drop of about 28% on that last drop there off that high. Let's look at the weekly. Talks to me more right now, or speaks clearer to me than the daily chart on SOX. There's that divergent high that I showed you back in 2018. There's a 28% drop that came. It was well telegraphed in advance. We were short the semis back here, and we had a breakdown, back test, and then it fluttered around. Didn't break down right away. It came in, tried to test those previous highs, couldn't, and then finally gave up the ghost once it broke this support level about 170. So these are still levels that I think are significant on my chart. 189.51-ish right there, and most importantly, here's that uptrend line I showed you on the daily chart we're watching. You can watch it here on the weekly, and I wanted to point this out. So back then, before that 28% drop in the fourth quarter last year, we had negative divergence at the high, right? And since that point where the divergences started, right here, this is where they started at this point, they've simply extended. Now, they're not confirmed. These are potential divergences. This is where I need to be very clear. There are no sell signals at all. We don't even have confirmed divergence. To confirm it, we would need to see this PPO, which is now pointing straight up. This is a momentum indicator. Pointing straight up means strong bullish momentum. That does not mean short just because the semis are going up and nobody can believe how much they've gone up. No. If we turn down, and again, that's the nature of the beast. I just spent some time on those other charts showing you that this thing, when it turns a corner, it turns on a dime, or it can turn on a dime. So if we break down below this trend line soon and come on back in, that would probably give us, or sooner or later, a bearish crossover here and then confirm that divergence. And what does that mean to me? Well, small divergence equals small drop. Big divergence equals bigger drop. So if we come on down here, 144.20, again, from where we're at now, we would be falling from higher levels, and that would be, if I can grab it there, about a 33% drop. And again, depends on what happens. Let's just take it from there. And there's certainly the potential for more, but that's what we're looking at right now. But again, if you want some rough targets, there they are right now, these three levels there. Okay, and once in a while I'll get requests from members on some of the other semiconductor ETFs. I like SOXX because for a couple reasons. Number one, again, it tracks the PHLX Semiconductor Index. That's by far the longest standing semiconductor index. That was the first, and it's been around forever. So you can look going back to the mid-90s on that to get charting history. And the other thing is it also, again, tracks SOXX and XOXL. But this is SMH, another popularly traded semiconductor ETF. And so let's just go over the charts. What you can see on this is a 10-year weekly chart. And pretty simple stuff. You can see coming to the left, off to the left of the chart here, we had negative divergence building and then a big drop. I'm sure that's well into the double digits, or bear market if you want to call it that. We had a nice clean up trend line here. And remember, trend line, not really to be concerned. When you see a trend line without divergence, you can start buying pullbacks to support. But eventually you get that divergent high, you get overbought, extended persistent overbought readings, and again, lower and lower overbought readings gives you the negative divergence there, and then boom, your sell signal came right here on a breakdown, and that was a drop in semis. That we had not quite divergent low, but here's our next uptrend line, and again, divergent high right there. Breakdown, that was a correction, and I just wanted to highlight this. Just like SOXX, we have very large potential negative divergence. Only potential, needs to be confirmed, and you can do the same thing. Just draw a trend line here off the lows. Make sure you're using log scaling, otherwise you will get a different picture. That's arithmetic scaling, aka linear. The trend lines don't fit. You want to, especially on a security that has a range from about $21 up to $125, you want to use log scaling. It just puts every candlestick in equal percentage moves, not dollar terms. So a candle back here that is, you know, a certain width or distance from high to low, if it equals here, it'll be the same percentage moves, and that's going to give you a more accurate reading on the trend lines and other levels there. SMH daily chart here, you know, mixed bag of technicals. I had a downtrend line right here, which is broken out. We had a breakout, a back test, and that's bullish. And so you want to watch that. You want to pull back. We already back tested it once, but that may come in as support if we get a decent correction in the semis. So you just have to extend that trend line. But what we're watching right now, and again, we've had quite a bit of a rally since then. I'm still watching this trend line off the lows on the 24th. It's clean, well-defined, and you can see on SMH, I can draw a divergence line because we have an equal high on the PPO as long as prices are making a higher high. And by the way, this is very steep divergence. When you have equal or lower lows, or equal or lower highs on the PPO, and higher highs in prices, that's negative divergence. So we don't have the divergence on the RSI, but you have an extreme overbought reading. And again, we know what happens when you hit those extreme overbought readings. Doesn't mean you're going to get a correction right away, but you usually do. And the more extreme it gets, usually the bigger the drop is. So there it is. The risk reward. in my opinion, on the semis right now is very, very poor to be, even to remain long, but more so especially to chase and go after new longs. If you want to continue to ride the trend up, the trend is your friend. Here's your trend line. Just, don't be married to those, and instead of stop below the trend line. There's a little bit of support here on SMH right here. You can see these candles right there. Maybe a gap down below there would put in an island cluster top on SMH. So with Intel reporting tonight, that's certainly something to watch. SXD, the other one, clean. Here's your rising wedge. Clean negative divergence right there. Almost confirmed. It would be on a bearish crossover there on the PPO. What else can I tell you on that? That's not much else to add. So basically all the same trend lines. That's the bottom line. It's no surprise. These hold a basket of mostly the same stocks. There'll be different weightings and a few different components in some or the other, but that's what the weekly charts look like. Now let's just roll into the top components and then we'll wrap this up. I'm going to start with the 800-pound gorilla in the room. That's Intel. Intel reports tonight after the bell, so that's another reason I'm doing this video. I'll spend a little more time on this one than the rest because this is by far the biggest semiconductor. The market cap on Intel is 268 billion. The next largest component I'm showing here, let me make sure I have my watch list sorted correctly. And I go to SOXX. What I'm doing is populating a watch list of the holdings on another page, another monitor here. Taiwan Semi comes in next at 186. So again, 268 billion on Intel and 186 billion on Taiwan Semi. So this guy is the leading semiconductor, make no mistake about it. Lots of things I see on this chart. Number one, first and foremost, probably the most important thing is this level here, about 57.40. This was our all-time high before, and it broke it out recently. This is a great example of what I've been talking about a lot, and I talk about every earnings season. Do not chase breakouts right before a company reports earnings, whether it's a long side or a short side breakout, because it's very, very unlikely that that breakout will follow through and play out to whatever the measured target of the pattern is. Why? Because who's going to take a big position? As a stock becomes close to reporting earnings, everyone's going to sit, those that are investors and holding the stock for a while, they're going to sit tight, see what happens. But you're not going to have a lot of new money flow into it from either shorts or longs because it's a crapshoot. Earnings can cause a stock to gap either way, and nobody wants to be caught on the wrong side of a gap. So therefore, on face value, that was a very bullish breakout. We gapped above the resistance level. Nothing's more bullish than a breakout that occurs on a gap because it leaves everybody behind that, and clearly takes you above the level. But then you can see it's stalled out. And look, we've already backfilled the gap today. And we've come right back down to that 57.40 level. So there's one thing, is the gap has now been backfilled, because a lot of traders say that, gaps, that you don't want to leave any unfinished business because gaps usually get backfilled sooner or later. So there's no unfinished business left. The gap has been backfilled. It's brought us back to the breakout level. So we've also back tested now the breakout to new highs in Intel as well. And it's brought us to the, this is the primary trend line I'm focused on right here. This is the trend line off the lows, but I have more reactions on this trend line. So I have Intel at intersecting support levels, the 57.40 key level. It's the bottom of the recent gap. It's the level of the previous highs, roughly where we broke out, and it's uptrend line support. So tomorrow is going to be big for Intel. If it can, gap up or move up after earnings tonight, great. And this, if you're bullish on the sector, again, no reason to go long right before they report. But let's say they hold up after earnings, and you can buy it here. There's your trend line. You can set a stop above the trend line and or that 57.40 level and let it ride. However, if you're looking to short Intel or the semis, you want to see a break below this level. Doing so will have taken us back down below the trend line as well as the 57.40 level. And what that means is this was a bull trap, aka a false breakout or failed breakout. And if we gap down tomorrow, it would also be, that's an island of candlesticks there. You could have a potential island cluster top if you gap down tomorrow well below that 57.40-ish level. Negative divergence tells me that odds favor downside, whether we pop tomorrow briefly. But as long as these divergences are intact, I don't chase breakouts to new highs that are extremely overbought to get there, just to get to the breakout point, and still, just now barely coming off overbought levels, and also the negative divergence. So that's the daily chart. Those are the things to watch for Intel. This is the weekly chart here. Simple stuff. Again, these divergences work. They don't work every single time, but much more often than not. Divergent high 28% drop, divergent high 34%, 34%, 14%, and this last time around, back in 2018, I was posting this wedge very frequently, saying here's a big bearish rising wedge in Intel, negative divergence, everything you like to see, waiting for a sell signal. Even before it broke down, I predicted a 24 to 32% drop, 24% my minimum target, and we pushed about another 2% up within that wedge before that last update, before we broke down, and we hit my first target, or my minimum target, to the button right there. 24% drop and a bounce off support. So far, that's all that is a breakdown, a bounce off support, marginal new high right here, and what it's done is simply extended the divergences that were already in place back then. So again, this is a big if, but if Intel reverses soon, that divergence on the weekly will be confirmed. Bigger divergence typically equals a bigger drop. So my target now remains, this was my second target back then, and it still is. It's much more than 32% now, by the way. It would be from the highs just recently. If we get down to that 38.27-ish level, it would be a drop of about 36%. So I'll have to update that. But again, no sell signals yet. It's just a potential setup. So we'll see what happens after the bell today. All right, so let's go through the rest a little faster and we'll wrap this video up. Taiwan Semi, busy chart. Let me clean this up for you and just show you this. This is all I would look at right now. I often say, as I've been talking about the stock market, right now in the semis, we don't have any sell signals. Well, sell signals come on either a breakdown below a bearish technical chart pattern, break below a well-defined support level or resistance level. They can come on a bearish candlestick pattern or candlestick reversal pattern, but you don't have to have a sell signal to make an objective short on a stock. The other way, of course, that's one way, and the other way is to short a bounce into resistance if you think there's a good chance the stock will fail. And that's the case here with Taiwan Semi. Now, I haven't checked, I haven't scrubbed them for earnings yet. I don't know if they've reported that. That might have been their report right there, that big gap. But what I can tell you is this stock has failed, it's a 2-year daily chart, on numerous attempts to get through that 45, 46-ish level, including most recently. It's hit it, can't get through. PPOs at high level turning down. We are at the most overbought we've been on this stock in years right now, or just coming off there. So yeah, the way I look at this, at the very best case scenario, if the stock were to break above that level, it is too overextended, too overbought to do much, and at best case it would probably have to consolidate for a while, back test, before it could move up another, and I'm talking the next 10-20%. So the way I look at this, although we don't have a sell signal, I think it's an objective short. Again, assuming you've scrubbed it for earnings, and it would certainly be more objective, much more, if you had a sell signal in the semis. But maybe a starter position, say a half position here, and I'm just speaking hypothetically. You short it here, you put a stop above, give it, it's semiconductor, they move a lot. You keep a small position, you can use a wider stop. Let's say you do 5, 6, even a 10% stop loss order. You might say, well, Randy, that's a big stop, 10%. Again, you can use smaller if you want, but you're going to probably get stopped out if you run a 3, 4% stop on a stock like Taiwan Semi. The way you get around that, just keep your position size down, and also make sure your stop is in line relative to your target. So if you're using a 10% stop, then you'd be shooting for probably a 30% or so downside, which is very doable and very possible in Taiwan Semi. So that's it. So you could short it at or around that level, even right here, with a stop somewhat above. Natural targets be the top of the gap right here. You can see where the crosshairs are. There's a gap. There's the bottom of the gap. There's a trend line, and there's 2 ways to do it. Either short it for a quick pullback trade, maybe a gap backfill. And again, I'm giving you just generic example here. Backfill the gap. Or what I'd be more apt to do is hold off on this one. Maybe you want to come back for a back test of the trend line too. That's another objective target right there. Or if you shorted it here and you started to see the semis roll over, especially a breakdown of those primary uptrend lines on the semiconductor sector and the ETFs, then what I would do is just allow this to be a runner trade. In other words, if it starts to play out and it goes on to break this trend line, just periodically ratchet down your stops, and what that does, you're opening the door for this. When we zoom back out, remember, you look at the daily charts, you're looking at things that are kind of putting in the smaller picture. This is the bigger picture. This is Taiwan Semi. This is a 10-year, right here, a 10-year weekly chart. And you can see the divergence. We haven't even made a new high, so we only have potential divergence. If this stock continues higher, it will have very big divergence right here on the weekly. Right now, this was the last high right here, so that's our last divergent high. But to kind of put it into perspective, when this stock drops, even these corrections, if you will, within this this is a bull market right here, but these corrections in Taiwan Semi, can measure easily 30, 20, 30% or more. And again, that's within a bull market. Now try to imagine if this stock were to enter a bear market, what that might look like. Here's a bear market in Taiwan Semi. From top to bottom, that stock fell 85%. So that's what you call a runner trade. Use wide stops. If you're in a bear market, I can tell you this, there's plenty of opportunities. I love trading bear market rallies, so you'd probably want to cover them when the charts indicate and then jump back in. But and if you do that and you swing the trends, you can do much better than 85% or so over a period of a year. But again, I just wanted to point out that that's what corrections look like in Taiwan Semi. Here's a 50% drop right there. There's a 50% drop again. So from here, can this stock drop 50%? Very possible. There's I already had a trend line there. There's your primary bull market uptrend line off the 2008 lows. The semis and a lot of tech stocks bottomed in late 2008, where the rest of the market did early 09. But you break that trend line, you're going to see probably a 50% drop from the highs easily if and when this bull market trend line's broken, and probably quite a bit more than that. So just food for thought there. Okay, I'll just run through these fast. This is AVGO, Broadcom, got extended, broke out recently. This is the level that I'd watch on Broadcom. This was a previous high here. We had a divergent high, big correction there. Came up, tried it again, failed, but then gapped above it. So that's bullish. Here's your breakout. So far, so good. But we broke this minor trend line. It might want to come in for another back test of the trend line there, or the breakout level, about 285, big level. But if it fails that, bigger picture would be and again, I'm talking bigger picture stuff. If it failed that breakout, that would be pretty bearish. But let's not focus. That's not one of my favorites. I just wanted to cover it. Here's one that I think there's a lot of meat on the bone, and another one where I think there's an objective short. Again, I'd only take maybe a half position right now because the sector is bullish, but NVIDIA is done, in my opinion. This is a generational top. NVIDIA, for those of you not familiar, this is one of the big, or I believe bigger than AMD, the two big GPU makers, NVIDIA and AMD. GPUs are graphic processing units. That's what the gamers use in their PCs to play video games, but it's also when Bitcoin was the big bubble, that's what they were buying to, individuals would buy to do what they call mining the cryptocurrencies. They'd run their computers all day, and it would make little bits of Bitcoin or whatever. That's the extent of how I don't know the details of it, but I can tell you that it was driving sales through the roof on GPU, especially the high-end, very profitable GPU cards. Well, we all know what happened to Bitcoin. Yeah, it's had a little rally lately. It's kind of reflected here even, but Bitcoin, the bubbles burst. Bitcoin will never probably see those highs again, and you can see the bubble has burst in NVIDIA too. So this was the Bitcoin craze, a big part of that driving this stock up. I just told you the fundamental point of view. Maybe I'm wrong, but I can tell you from a technical perspective, this chart speaks pretty clearly to me. I see, again, we're on a 10-year weekly chart, a very well-defined uptrend line there, divergent high. It broke, and what happened is the stock continued to wedge on up within this wedge here. The divergences just continued to build until finally we got a breakdown that stuck. Very impulsive selling from highs to lows. This stock plunged and it doesn't look like much because of the advance before it, but it's a 57, well, almost 60% drop, and we've had a kickback right into resistance. So this one, from this weekly chart, here's what stands out to me. Almost 60% drop. This to me seems like nothing more than the first leg down in a new bear market. Counter trend rally right into resistance there, about 187.25 or so. Makes it objective short entry. Hey, might not work out, but that's what a stop is for. Stop somewhat above, and you swing it for the next leg down. Where would that next leg down be? At minimum to 113. With a preferred target of about 95.50. That's where I think this one's going at minimum, and it wouldn't surprise me before all said and done to see it revisit this long-term trend line. But let's just focus on those levels now. What does that mean for you if it does play out that way? About a 48%, 50% drop from current levels. So there's one you could, again, use a 10% stop loss order. You're risking, a dollar to make $5 if that target's hit. We look at the daily chart. You can see here, there's that level, the resistance level on NVIDIA right here. See all the reactions there, reaction there. Oh, no, this is the level. I'm looking at this line right here. Reaction high, reactions from below. We had a candle, we had this is what I call a momentum fueled overshoot. A sharp move down, but we snap back to close the day right here. Hit it again, that second candle, hit it again there, and then gap below it. So that's why I have that line there. It's a big old gap there. That's the top of the gap. There's a lot of reactions there. So it's whether it pans out or not, that I cannot promise you. But I can promise you it's an objective short entry because you have a stock that is clearly in a downtrend. There's your 200-day moving average too, coming into play, stalling out. The stock is trading. It's been below the 200-day since it broke down, and it's back testing it from below. Back testing the top of the gap, so you go short here with a stop 10% or so above if you're willing to swing down for 50 or so percent short, and again, it works out or it doesn't. Okay, I gotta stop this video somewhere. I could go on and talk for days about the semis. There's just so many clean looking charts that stand out. We just need to see what happens here. I want to just finish up with Texas Instruments, another big semi. This one's almost $112 billion market cap. But what stands out to me is we had a downtrend line right here, pretty well defined. It was taken out, was broken out, and that's bullish. But thing about charts, that's why I have a lot of lines up. I try to look at all the levels that different traders might be watching, Fibonacci levels, moving averages, trend lines, price resistance. So whereas bulls saw this, and so far they're right, broke out, and it's been moving higher, what some might not have seen is this 116, 117-ish level is defined by quite a few reactions. You can see them all here. In a big old gap right here, and so this one is at resistance. So it broke out there of a downtrend line, but yet I think this is, I always say benefit of the doubt. You need to see this level taken out, and so far we're struggling with that. So here's another one you could technically, take a shot at because we don't have a sell signal, but you're at resistance while overbought with negative divergence to boot on the stock right now. Here's your divergence right there. You could draw a trend line maybe to add to on a breakdown, but the way I would do it with this is with the other ones, partial positions, maybe a half a position, wait till the semis break down to bring it to a full position. And again, don't underestimate how far they can drop. So you could use a quick tactical trade. I don't have targets on this chart right now, or you can go for the swing for the fences and say we're looking at possibly a major top in the semis here. There's your big divergence on the weekly. Where do I think Texas Instruments could end up within the next year or so? Down here, 83.71, and that'd be a drop of about 30%. So that's it. We'll wrap up here. Well, by the way, yeah, 50% if we enter a bear market in both the equity markets and the semis. I think 50% is very doable. So whether you swing it that far or not, it's up to you. But that's what I can see as a possibility in the charts. We're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.